Now, staying in the earnings arena, Barloworlds Russian unit continued to weigh on the industrial group's performance. A near 37% decline in revenue there brought the group top line down during the half year, and that contributed to a more than 20% slump in interim headline earnings per share. And joining me now for more on this is the company's CEO, Dominic Sewela.
Certainly it was tough, but it's something not unexpected. I think we did, give an outlook last year in November to say, we think with the commodity prices where they are, the softening, we think we're going through a downturn, in the mining sector. And what was certainly a surprise was the geopolitical, challenges that we're facing, largely due to things like tariffs, and we had an expectation that hopefully the war between Ukraine and Russia, they would have gotten around the table to sort of have a ceasefire. Other than that, the rest of the stuff is just in the way a cyclical business work. I mean, the market is up and down, and as long as you are able to focus on the levers that you have control over, the other stuff you don't have control over.
Well, Dominic, I mentioned in the intro that the Russian unit does continue to weigh. So just talk to me about the level of pressure that industrial services company there in Russia is exerting. Let's first actually start off with that.
Yeah, I guess the sanctions are weighing heavy on the business, because the nature of the sanctions is that they've been ratcheted up since the beginning of the war to now. But what happened, in the business, unfortunately, it has been a breach in terms of export control. And that has led us to basically apply brakes in terms of imports of parts, to make sure that we don't breach, the export control any further. And, in the absence of that, you're basically depleting the inventory of parts that is, in a stock holding, and you're only limited to providing service, to basically labor, to some of, customers that you're able to do business with, because most of the customers have been sanctioned. And then you can see actually the drop year on year and the impact that has had in terms of our revenue, as well as basically, performance. And we've tried to give the market a sense that if you exclude Russia, in fact, we haven't really performed badly. We're flat, at 2.2% down on revenue. And if you look at the sales in equipment Southern Africa, they're flat. You look at volumes in England, it's flat. But Mongolia has been a star performer in that it has delivered, above expectations.
Yeah. And just going back to that Russian business, are there any immediate strategy moves that you are considering, or any kind of strategy changes? And is the potential ending of the Russia-Ukraine war maybe in those conversations?
Yeah, I think fundamentally from the beginning of the war, the board took a view that we need to remain in Russia for the long term. Because when you look at Russia, it is endowed with all sorts of mineral resources, gas, oil, and other minerals. And therefore, in our, landscape, it becomes very important, because it gives us the diverse geography that we need with different metals, or commodities compared to Southern Africa or Mongolia for that matter. So, so from that point of view, I think we said we'll run the business for break even, making sure that there is no value erosion, to shareholders, but more importantly, also preserve value for the company, because what you don't want is to actually lose employees, lose the assets, because even if you try to exit that market, you're not going to be able to realize value. At best, you're going to lose money. And therefore, you then lose a competitive advantage of being able to get back when things have normalized.
Yeah. Let's talk about your capital investment priorities and the funding thereof. I mean, we're in a lower profitability scenario here. How much room then are you making for capital expenditure and investment initiatives in as far as it goes into debt?
Yeah, I think one of the key things that we gave guidance to in November was that we did anticipate that in terms of capital allocation, it'll be very important to address that. And what we've learned over the years, whenever there are cycle downturns or, shocks in the environment, a company that has got a solid balance sheet, that has preserved cash flow, its ability to maneuver during the time is high. and we're precisely doing that. If you look at our interest cost year on year is down, and we continue to make sure that we pay dividends to our shareholders in line with our dividend policy. And you would have seen that we've paid, 120 cents per share. That's part of our capital allocations strategy. We'll continue to also address the issues around debt. Obviously, we are keenly waiting to see what MPC is going to do, Thursday, this week, whether are they going to raise the interest rates or they're going to hold. And that's something that we're looking at. And also making sure that in terms of the covenants we have with our funders are in place and solid. And, because those are the things that we as management can have control over, our cost containment, making sure that we eliminate any waste we have in our organization, to make sure that, the cycle will turn. And I've seen it many years. I've been in this business for 18 years, and these cycles come and go. You got to just make sure that, when they go or when they're no longer there, you're well placed to take advantage of the growth spurt following that.
All right. Dominic, this reporting period ended before the 2nd of April when the tariff story really commenced in the U.S. and disrupted markets. How then have conditions been for Barloworld since then in the second half of the financial year?
Yeah, certainly. I mean, it hasn't impacted, our customers in the same way. When you look at the PGM and other commodities, those are excluded. Obviously there's uncertainty hanging around diamonds, hanging around, steel, as well as, iron ore. And what this has done, it has created, a level of uncertainty with customers. Therefore, they're not willing to commit to spending to buy capital goods. And we've seen them opting, to use, rental asset. What that does is that it then increases, your working capital cycle. But our order books remain healthy. We've seen our order book increase by about 1.7 billion. In our equipment business, which speaks to the fact that there are customers willing to commit, in other segments other than mining. When you look at energy transition, we're seeing spend in that environment. But we look at other commodities in certain brownfields, Vendetta committing to buy equipment, and some of our customers in the copper mines willing to commit to capital equipments because those commodities are strong.
All right. Well, we do have to wrap up that conversation. Thank you so much for your time and giving us more detail on those numbers that came out from Barloworld, Dominic. And of course, we will continue to keep a close eye on the new co offer. That was Dominic Sewela, CEO of Barloworld.